Today we will analyze this monthly dividend company called Realty Corporation with the stock ticker ADC. And as always, bro, we will take a look at different financial statements, meaning income statement, balance sheet and cash flow statement. And all the relevant data for the most important bullet points can be found here on this website called Macro Trends. And now, bro, without further ado, let's start with the income statement and more precisely with the total revenue, okay? And always when we will analyze the data, we will analyze for the last 10 years because this will give us the better perspective of the development of the company. And always, bro, when we analyze this data, we will decide whether we should buy the shares or sell the shares of this particular company, okay? And now, bro, without further ado, let's start with the total revenue analysis. And as you can see here on the graphs and also here in the data, the revenue is growing through the all 10 years, which is amazing, so we can mark this as a buy. And now we come to the gross profit. Gross profit is also obviously growing, which is amazing, so we buy this as well. And now we come to the gross margin percentage, which is the gross margin ratio, and we can calculate this by dividing gross profit with total revenue, okay? And preferably, bro, we want this to be always more than 40%. And as you can see here in the data, it was 90%, now it's around 80, 88, which is good. It's more than 40, but unfortunately it's still falling. So for example, bro, in this case, we will still mark that as a buy because it's more than double the percentage, okay? Which is absolutely awesome, bro, awesome. And now we come to the operating income. Operating income basically means that all this income that is accumulated here in the operating income will at some point become part of the total revenue, okay? And of course, we want this to be growing as well because this is basically future income. And it's growing, so we can mark that as a buy as well. And now we come to the net income. Net income had quite good growth during the years, except now in the last year it fell slightly. But still, bro, nonetheless, it's always growing, so that's a good sign and we will mark that as a buy. And now we come to the net income margin. Net income margin is calculated by dividing net income with total revenue. And preferably, bro, we want this to be always more than 20%, okay? And as you can see here on the graph and also here in the data, it was around 50, 55, and now it's falling up until almost 20. So that's still kinda a buy, but we want to be in our analysis as harsh as possible because this will give us more free room. So we will mark that as a sell, okay? And now we come to the capital expenditure divided by net income. And as you can see here, it's growing, falling, growing, growing, falling. So we will mark that as a buy still, okay? And overall, bro, based on the financial data from the income statement is definitely a buy because we have 1, 2, 3, 4, 5, 6 buy flags and 1 sell flag. So definitely, bro, income statement is marked as a buy. And now we come to the balance sheet, and here we will analyze firstly long-term debt, okay? Preferably, bro, we want long-term debt to be as little as possible or even going lower and lower through the years. But unfortunately here the long-term debt is growing precisely here in 2023, which could mean that they started to invest much more into the company because as you can see here in the income statement, net income fell slightly in 2023, okay? So that could maybe explain this. For that we have to dig deeper into the income statement and balance sheet, obviously, basically annual reports. But we don't have time for that because your attention span is completely low, okay? So we will mark this as a sell. And now retained earnings are earnings that the company reinvests back into itself instead of paying it to the shareholders, okay? And preferably you want this to be growing through the all years because that means that the company wants to reinvest all the money back, okay? And here, unfortunately, ADC doesn't disclose all the data, so we have to mark this as a sell. And now we come to total equity. Total equity is basically all the cash, you know, all the assets, everything that the company owns. And as you can see, it's growing through the years, so that's perfect. We mark that as a buy. And now we come to the return on equity. Basically, this is calculated by dividing net income from the income statement with total equity here, okay? And preferably, bro, we want this to be more than 10%. And as you can see here, it came quite close in 2015 to like 9%, but overall it's falling up until 3%, so this is completely terrible. So we mark that as a sell, of course. Total liabilities, you want them to be as low as possible and preferably stay the same through the whole years. But here you can see they are growing, which is bad sign, so we mark that as a sell as well. And now we came to debt to equity ratio. Preferably, bro, you want this to be lower than 50%, which you can see that it's kinda almost 50-60% here from 2019 to 2023, which is an amazing sign, bro. So we mark that as a buy, because that means that they are trying to get rid of all the debt, and the less debt that the company has, the better it is for us, okay? And now here, balance sheet is kinda bad, to be honest. We have 4 sells and 2 buys, so we have to mark balance sheet as a sell. And now we come to the cash flow statement. And if you watched previous analyses, you are maybe a bit confused why we have now 2 different metrics that we will analyze, meaning P/E ratio comparison with the competition and intrinsic value, okay? But nonetheless, bro, let's start with the capital expenditure as always. Capital expenditure basically means how much money the company invests into new machines, new production, maybe new land, new factories, new everything, okay? Basically into the new equipment. And preferably we want this to be more than, like, basically growing through the whole years. And I notice, bro, that I'm saying too much preferably, so I will try to stop, of course. And here you can see that in the last years they are investing quite a lot in the company back, which could also maybe explain why the long-term debt is growing and growing through the years, okay? And now we come to the stock dividend. So this is basically dividend that they pay per share. And here I want to tell you one thing, okay? They started paying dividends in quarterly time, okay? Up until 2021. So here, bro, I calculated the average dividend that would be paid during the all 12 months, okay? Even though here they had quarter payments. In 2021, they started with monthly dividends. And still, bro, you can see that the dividend payment is growing quite well, you know, almost double in the last 10 years. So we mark that as a buy, definitely, okay? And now here we come to the new data that we will analyze, meaning P/E ratio comparison with the competitors, okay? And here I listed top 8 competitors, you know, that this company has, you know. And as you can see, bro, their average is around 15%. And preferably we want this to be less than 15, okay? And here, I mean, not percent, this is just the normal ratio, okay? 15, okay? And this company, bro, has 33, so we have to mark that as a sell, because that means that this company is overvalued in terms of the P/E ratio, okay? P/E ratio basically means how much dollars you want to invest for this profit, okay? So basically P/E ratio means that you are ready to pay $33 or 33 euros for €1 profit, okay? This is way too overvalued, bro. And right now we come to the last metric that we will analyze, meaning intrinsic value. So this is something that I added, which helps us to see if the company is overvalued or undervalued based on the Benjamin Graham's formula, which is introduced in the Intelligent Investor book, okay? And right now here you can see that when this company will have the price of almost $60, then it is considered as a fair price, okay? And now when we go back to this ticker terminal, you can see that the company is currently trading at $56.89, which is below $59, almost below, yeah? So this is definitely a buy, okay? Okay, and now we marked cash flow statement as a buy as well, because we have 3 buys and 1 sell. And bro, now we come to the final decision. I think that this company is an interesting company because the income statement is basically perfect. They have amazing gross margin ratio. They have amazing, not amazing, they have quite good net income margin. They have an amazing debt to equity ratio, bro, especially in the last, how much? 4 or 5 years, which is around 50%, less than 60 definitely, which is amazing. And also they are obviously paying monthly dividends. Their intrinsic value is below, like their current price is currently below intrinsic value, which is also a good sign. The only thing that I don't like, bro, is the P/E ratio and the long-term debt. Long-term debt is good, but still a bit too high, you know, they are increasing the debt too much. But bro, nonetheless, bro, I think this stock could be on my watch list, bro. It's not as good as the other ones that I have, but bro, let's put this stock on a watch list and then let's see how it develops, okay? And now, bro, without being said, do the hard work and see you on top of the world.